Good afternoon. First and foremost, Paul, Amir, and I would like to offer the best wishes to all of you today. Most importantly, we hope that COVID-19 and its aftermath have not affected you and your families too negatively. In assembling my remarks today, I'm not going to emphasize changes in GDP or the stock market, the corporate lending market, or the elections. Our attention is focused primarily on the wind down of the fund and the game plan for our individual investments. During the Zoom call that we had several months ago, we presented a series of events that forced us to take the painful decision to restructure Kilimanjaro Fund. Namely, first, Kilimanjaro having their credit line terminated by Citibank and forcing us to repay by March the 31st, 2021. Secondly, the impact of COVID, changes in economic activities, and uncertainty on the companies to which they lend money. Number three, a projected distribution rate of only 2.5% for the fund going forward, based upon the return of the Federal Reserve's zero interest rate policy and the fund no longer having any leverage. Our June call and related emails laid out the steps of the plan. Number one, reduce the Citibank credit facility so that we did not need to confront a last-minute need to sell investments at fire sale prices. Once again, we were not singled out by Citibank. They made a blanket decision to terminate credit lines for all similar funds such as ours, but we wanted to make sure that we weren't waiting till the last minute. Number two, suspend the December 31st redemption window, stop accepting new investors or additional investments into the fund, and convert all quarterly distributions to cash only, eliminating the refinancing or reinvestment option. This was putting all investors on the same footing as we manage the interests of the fund for the overall interests of the individuals in our group. Number three, setting a target end date of 24 to 36 months in the future, at which point we could make major cash distributions. Number four, manage the investments of the fund to be able to make those final distributions in 2022 and generate returns in the interim to be able to continue to make quarterly distributions of interest income until then. And number five, appropriately reduce our operating costs. Hopefully most of you have been able to read the September 30th letter, which outlined the steps that we've taken so far, and overall the progress has been good. First of all, we were surprised that we were able to pay off the Citibank line fully on September 30th, 6 months early. This was the result of several of our positions meeting our target prices sooner than we anticipated. It removes a major risk factor for our fund going forward. I know John had asked me a question a month or two ago about being able to reborrow under the line once a position was sold. And I guess that's an aspect of the fund that we didn't really go over in detail, but part of the constraint in the pay down with Citibank was as we sold individual positions, that amount was swept permanently against the credit line. So second major thing that's happened to the fund that we outlined in September 30th memo was largely on the basis of the movement of those several credits. The mark-to-market value of the fund has increased from a 72-cent low point in March and has risen every month from April till September, having a positive movement. Previously, we had forecasted a potential recovery range of 80 to 90 cents on the dollar of the January 1st value. We're now confident that we're going to be at the upper end of that range. Going forward, we still need to convert positions that have an indicated market value into actual hard cash. So again, we try our best every month to mark the positions to what is indicated as market. But at this point, we are into less liquid positions, and being part of our challenge going forward is just converting those indicated market values into actual sold positions in hard cash. Having said that, only one of the remaining positions that represents only 1% of the value of the portfolio has a maturity before the end of 2022. So it's not going to be by maturities and repayment in the ordinary course that we're going to be able to achieve the cash distributions, but by monitoring them and selling them opportunistically over time. The third major area is we have been able to obtain reductions in audit, tax, accounting services, among other items. We've done that, yet maintained Eisner as our auditor. I know that was one question that had been raised earlier, and we were able to get a reduction in costs from them, but stick to the same auditor, which I think was something that a number of investors had raised. We've moved to a quarterly account statement, and we've moved the cash distributions to the last day of each quarter, as opposed to 60 days into a quarter. We've received feedback from a number of our investors over the past 5 months, and we appreciate that and try to take it into account. We're going to continue to balance the views of those who believe that we should prioritize distributing cash as quickly as possible with those investors whose preference is for maximizing cash recoveries over the longer term. We're expecting to make a single major initial distribution with minor ones after that. In the interim, we will continue to make those quarterly distributions of interest income. As we mentioned earlier, the target date we think is moved up by about 6 months in terms of being able to make those major distributions. So instead of the end of 2022, we're thinking it's the beginning of 2022 for the first major distribution. And I'd like you to remember as we go forward that fully 40% of the total capital is ours, and we continue to have pretty much the identical incentives than what every investor here has on the call, except that we've also agreed to pay personally any of the excess wind down costs out of our own pocket. From the bottom of my heart, I really want to thank you, and I think my partners do too, for everything that you've done over the past couple of years. Remarks. Paul, are you on, or should we go to Amir? You want to add anything, Amir? Because it looks like Paul's actually off.
No, Murray, nothing else. Yeah, from the fund perspective, obviously, I just wanted to echo your comment about thanking everyone for obviously supporting Kilimanjaro over the years, and obviously being with us as we wind down these operations over the next 12 to 24 months. Just wanted to echo that view. Paul's just calling me on the cell, so I'm just going to see if he had an issue getting in. Hey, Paul.
Yeah, it looked like he dropped off the call, so let's give it a minute, see if he can get back on. Otherwise, we'll then turn to open it up for Q&A.
I will say this is
Murray, I'm just going to put Paul on the speaker, and then he can, because he's not getting the connection. Okay. Paul, can you speak, Paul? Yeah. Can you guys hear Paul? No,
No, we can't hear him.
no.
If I speak louder.
Amir, why don't you take whatever, have Paul give you any remarks,
Sure, I'll do that.
and then you
Paul,
can just,
do you want to share any remarks and I can just voice over?
and if you want to just put yourself on mute, Amir, I'll speak for a couple minutes.
All right.
I think one of the aspects of how 2020 from a business perspective has gone is that results in the first quarter, second quarter, third quarter of a number of our companies have been all over the map. And some of them you expect a very strong second quarter or first quarter or third quarter based upon COVID, and we've been surprised. I think you know that one of our positions historically has been the Atkins protein bars. And early on in the COVID, I guess, progression, that was the kind of thing that people wanted to stock up on and put in their pantry and say, well, if I can't find other food, at least we'll have some protein bars in the. And so the first quarter was very strong because that started to kick in March. In the second quarter, that sort of pantry stocking had stopped, and it came to be a more steady state. And then people realized that, well, a lot of protein bars are consumed when people go to the gym. And so since all the gyms were closed, all of a sudden that source of demand, the part that was purchased more impulse, fell off very substantially. So we went from a very strong first quarter to a very weak second quarter. And then the third quarter surprised everybody again on the upside because it was reaching back to a steady state. So that's a kind of position where we had a sort of disjointed thing. We had another company, Springs Windows, which makes window coverings such as curtains or blinds. And with COVID, there were a lot of people saying, and I think the data is borne out, that home renovations has been one of the strongest parts of 2020. And so we were expecting real strong results. They had strong results in the first quarter, and we were expecting even stronger results in the second quarter. And then we're surprised when we found out that, yeah, the demand was there, but they suffered production problems because they had to close one of their plants. And so now that we're further on in the year, the third quarter ended up being a good quarter for them because they were able to get the production and they had some catch up that they were able to do. So, we've tried to stay flexible. We've overall been pretty pleased with how the underlying companies are doing, but it's been opportunistic which companies were going to do well when. And the good news is we were taking a number of them were hitting our price points, and that gave us the flexibility to pay off Citibank early. So Amir, are there any?
But Murray, just to add to that, there were, for example, as we have said in our previous newsletters, there were two other companies that we expected to refinance during a 9 to 12 month period, like when we wrote our June newsletter. And obviously in late Q3 and early Q4, we had, for example, ARS, American Residential, pay us off a total refinancing. They got bought out. So we got paid off. It was a top 5 holding of ours. And another one where we got a majority of our pay down, which was NN, is a precision firm that does precision components. We got paid, they sold a major part of their business, and as a result, there was a major pay down. We have a very small position left in that organization, but we got paid off about 90% of what we had. Those are two examples of refinancing that we expected, and they did materialize during that period. And I'll mention another one that we've spoken about before, our USS, which is our party business, as we all refer to it. Obviously, another part of the segment is large events. And obviously, most of having big, large events, given COVID, has come to a halt. However, they were able to replace that lost revenue with increased sanitation units, and, like, for example, washing stations, things of that nature. So a lot of the companies that we do have been somewhat agile in adjusting to the demands of COVID and the limitations as a result of COVID, and go into other side businesses, but also manage their cost structure and keep the EBITDA in line with ongoing cost reductions and cost management as well. So we've seen that EBITDA has held relatively well for many of our credits.
And were there any other comments from Paul that he wanted to pass on?
No, he said we had, when I spoke to him, he said we had obviously captured most of his thoughts.
And
just for the benefit, oh, there's Paul coming back in.
Look at that.
Perfect timing, Paul.
Don't ask me what happened.
Paul, we just spoke about some of the credits, some of the uniqueness in some of our portfolio. So we had made those comments. So if you want to add anything further.
No, everybody knows we're living through this incredible uncertainty where, the economy is open and shut and in danger of being closed down again. But at the end, the US and the US economy will prevail, and it's an onward and upward trajectory. Our problem is timing, and all of our problem is timing. But we haven't lost confidence in the underlying credits or in our ability to understand them. If it hadn't been for Citibank, we would be very bullish. But without leverage at these interest rates, we can't justify our fees. Just to put it crassly, our fees are too large, and our costs truly exceed our fees at these levels for us to continue to do what we're doing. But with leverage, we could have, because this economy will recover as it always does and prosper as it always does. That's where we are. We're a victim of the time.
So I see a question from Fred Marshall. Are there alternatives to Citibank? So Citibank is the largest provider of financing for the kind of business that we do. Probably represents half the total market. Amir and I independently had engaged in a process earlier in the year, knowing that the Citibank line was coming up, where we went and flew to 3 different cities, met with a dozen different providers, talked about all kinds of different structures that were available. And at the end of the day, the other ones were more structured in what they provide, meaning they would have forced us to lock into like a 5-year term. Well, knowing that our investors had a variety of cash needs, that's something that we didn't really think was palatable. Forcing everybody to lock in for a longer term. So the flexibility that the kind of line that Citibank had given us in the past was that you could increase it or decrease it at will. And the other options, the best of the other options, because there were others that were just more expensive. The other ones would have put some constraints on us that I think our investors would not like to have been tied up on. So let me look under questions. So Phil asked the question, if we assume that a vaccine will be distributed widely by mid-year 2021 and the economy rebounds, would you expect to be a positive influence on the prices you could sell for? If so, is that part of your strategy to wait for an economic rebound? So, I think we're hopeful that a vaccine comes at some point, that the economy turns around. But we're not really banking on it one way or the other. Yeah, we think that that could lead to some slightly higher prices. Probably in the way that we look at it, it would accelerate the time frame that we got to the target prices that we're hoping for. So if we think that most of what we remain are things that we think we're going to get, 99, 100 cents on the dollar, if there's a vaccine and the economy recovers rapidly, we're likely to get that sooner. It's unlikely that we're going to get materially a higher price. It's just that the kinds of target prices that we had would more likely come quicker. If you can imagine, we have a position in American Airlines that is wonderful collateral. The only two of the three gate or slot restricted airports in the country at LaGuardia and Reagan Airport in DC. We think the collateral is wonderful. If there's a COVID vaccine, we think that air travel will recover more quickly. The value of that will meet more quickly, but we're not going to get more than 100 cents on the dollar, and we're sort of aiming for something in the high 90s before we would get out. So it would accelerate the timing. It wouldn't accelerate the amount the recovery amount as much. Paul, do you have anything on that? Or
no, I think that's right. I think right now these prices, the market is extremely illiquid. Money has been leaving the market because, frankly, people have a more risk on appetite than they did, and maybe they're being too optimistic. I don't have a point of view on that, but this going into new names now. In the long, for the long term, doesn't seem like a reasonable thing for us to be doing. We'll be doing some buying and selling to maximize where we get to, but it's limited, and we're basically in liquidation mode.
So a question from the Waltz, which is, at our last gathering, you were quite pessimistic about the future based upon Citibank closing us out, and I think that. It says that is, others might be facing the same problem that we were. Any changes in that view? I think that was one of the major concerns that we had at that point in time. Citibank appears to continue to be going down that path. It has been bounced off a little bit by some of the Fed programs, which have bought into the corporate bond market that I think had not been programs that had existed in 2008. They sort of refined some of their targeted buying of things. And so the Fed, though the Fed didn't come into the loan market and the Fed didn't come directly into the non-investment grade market, it injected enough money into the corporate bond market in general that it provided an alternative for a number of companies. So I would say that overall that was a positive, that a lot of what we predicted, that Citibank closing us down and other down, would be a negative, continued negative on the loan market, and I think that has indeed come to pass. So the non-investment grade loan market that we operate has not snapped back the way other markets have snapped back. It's sort of in a grinding its way back mode. hopefully that. I think there's a chat function and a Q&A function. What can we learn from recent events such as 9/11, 2008 financial crisis, and now COVID, and their impact to investing? I think that's a impact on investing in general. I'm going to say that we are very focused on our little market, and I would say that John and Daniel and Doug, could probably give you some more perspective in general as to how those major events, affect investing in general. I will say, to come back just a little bit on the Fed. The Fed did a 1 or 2 day direct injection back in 9/11 to make sure that the plumbing didn't come off. In 2008, did a more concerted series of purchases. I would say with COVID, they did even more than they did in 2008 and did it quicker. The problem with COVID, it wasn't a liquidity issue, it was a real solvency issue for many companies. In 2008, there was more of a liquidity as opposed to a solvency issue. This time around, the Fed can't solve the problem of a company shutting down because it's in the restaurant business, or because it's in the airline business, or because it's in the cruise line business or the hotel business. Those are things that this time around is different. I don't know if John, Daniel, Doug.
I think there's a more mundane answer, which is the lesson from all of this is keep diversified and make sure you don't ever get too, not just by name, but by segment, because the lesson from all of these crises is diversification has worked.
Yeah, this is Daniel, and I'll echo what Paul said. All three of those events, 9/11, 08 crisis, and COVID, are three events that no one saw coming. They all came out of left field. And so to prepare for them is the way that we invest. And it speaks to what Paul just said, in that we aren't invested in any one sector, style, or area of the market. We are diversified not only in stocks and bonds and commodities, alternatives, US, international, et cetera, which plays for us and against us, right? When one of those areas is doing really well, and that one area has been the US stock market the last number of years, a diversified portfolio is going to lag. But when the markets do go down in those three times and others, it's when you wish you had a diversified portfolio. So
there's a famous stock market song called "Only Fools Fall in Love," and that's very important to remember. That you don't fall in love with companies, you invest in them, and you need to keep making sure that they're worthy of your temporary affection, and keep it diversified.
Can you hear me? Can you hear me, Dan?
Yeah, we can hear you.
Okay. So I would comment, yes, you don't fall in love with companies, you invest in them. And certainly we've seen the experience and the consequences of that with some very large companies. But I would also add, in this diversification mode, when we internally at Investec last year sat down and looked at the proportion of the portfolio relative to the overall portfolios, and came back to you individually and said, we'd like to see you in varying amounts reduce your exposure. Obviously, if we had any foresighted call, we would have taken it all out. But we didn't know that, right? We clearly didn't know that. But we did reduce most all of you. One or two wanted to stay where they were, but for the most part, we did. And that's just the lesson of, not falling in love with the company or the people running the program or anything like that. It's just hardcore investing, and diversification is absolutely the key. So, when you're in the wealth accumulation mode, you can be aggressive, you have years to do it and so on. But just about everybody on this call and most of our client base is in the wealth preservation and distribution mode. And so you don't get the kind of high returns that we'd like to see because we're busy protecting the downside and diversifying. And we're not chasing, in the hunt, as it were. So I think that's a very important element. This is extremely unfortunate. I would never have believed, if I think about our lunch last year, celebratory lunch with these guys, there wasn't one at the table that had any notion of what was coming with this. And some had even asked to be adding to the program. So that's where we stand. My question to you, Murray, just by example, or Paul, is should one of the companies out there that we're invested in wanted to go out in the marketplace to get a loan today, would their base rate, I would assume, would be lower? Remember, the loan rates are a base rate and then an interest spread based on what's happening in the marketplace in LIBOR. Would they invest today at a lower rate? Would they be able to borrow at a lower rate?
First of all, I want to address your thing on timing, which is I personally invested more money in the fund in June of 2019, just before our last get together. So I made the least bet in market timing on loans. In terms of we have a couple of real examples that Amir talked about earlier. They were both examples of companies that American Residential, which is the one that does heating, air conditioning, sales and service, and NN, which was the precision manufacturing company. One did a spin-off of one of its major divisions, and the other one did, in essence, a refinancing with a new investor. In both of those cases, of course, LIBOR pro forma was right around zero.
Right.
In one case, in ARS's case, where things had been going very well, they were able to do the new deal, but at a marginally higher spread than what had been done historically. And in the case in NN, where they had stumbled historically, they were able to do it close to the spread that we had. We had a very high spread on that one. That was the LIBOR plus 500 deal. For most of our remaining investments, if they were to try to refinance today, or if the company were sold, they would have to pay a higher spread than what exists in our loan facilities today. Okay. So meaning in the supply demand thing, there's still not a lot of people making new loans, and so the spreads are in general still higher than the ones that you would see in our existing portfolio.
Thank you. Are there any others?
Yeah, there's a couple more questions, Murray. If you want, I'll read one. One is, based on your selling experience to date, are your target prices, which you have sold, at near 90% of par value?
The answer is most of the stuff we've sold has been closer to 90, 97. There are a couple of things that we sold because we thought the companies might take longer to turn around. And so therefore, we didn't want to wait 5 years. We had Accurite, which makes wheels for trucks and automobiles. It's a company where we thought it was a really sound company. It might take a while. There's an example of a company where we sold for a cheaper price because we thought that it would take a number of years for it to turn around. But most of the things that we sold at prices approaching 100.
Is that because the wheels came off?
Something like that. No, that was a really hard one we struggled with because it had made a major acquisition. We were very confident with the sponsor. The sponsor had kicked in more money in December of 2019. The sponsor kicked in more money in this past summer, the summer of 2020. It had endured if you recall, the last fall, there was a General Motors mini strike turned down. So the fourth quarter results were bad. They were trying to integrate. They were doing all the right things, the sponsor. But at the end of the day, we said, it could take several years for this company to be operating well, and that's sort of beyond the time frame and scope of the fund. So we have to be cognizant of companies that might eventually turn around, but if it takes them 5 years, we might as well try to exit at an earlier time. So
and I think that's a real consideration. We've always said the great thing about this business is eventually they pay out at par, and until we hit the seats for luxury theaters, we maintain that point of view. But in the time frame we have available to us, that isn't realistic. And the cost to harvest will be way higher than the incremental value we can realize over the next 3 or 4 years. That's a problem, right? But we're not giving away bargains, and we're not going to start now.
Any other questions, Dan?
All right, give me 1 second. I got knocked out, but I just got back in. Let me catch up.
I believe Zoom shares went down 25% today after they announced the vaccine, or yesterday.
Yeah, Monday.
If you look at it's amazing when I guess it was on Monday when we had that tremendous rally and traditional Dow Jones kinds of stocks and NASDAQ selling off. I mean, it was a whipsaw, and again, nobody would have forecasted that over the weekend, right?
Right.
So the last question that I've seen so far is what impact the election may have on Kilimanjaro's holdings, if any.
We were talking a little bit about this earlier, and I think it comes back to the time frame. There will be changes because of the election, but and we've tried to be cognizant of companies that may be impacted by changes in legislation going forward. So we take that into account. But realistically, no one's EBITDA or profits are going to change materially over the next 12 months. None of our companies over the next 12 months because of the election. And I mean, we really do have a relatively short time frame that we're looking at to evaluate these companies and obtain prices and liquidate. So, we can, for example, we have one company called Anvil that makes pipe fittings, and pipe fittings, many of which would go into new infrastructure projects. So you could say, well, infrastructure may be more likely, but realistically, even if you got legislation that would improve infrastructure, put more money into infrastructure. It would then take a while to go out and identify the projects, and then once you identify the projects, actually procure pipe fittings. So it's we have to rely mostly upon the existing short-term trends that these companies are, and try to maximize value over that period. I don't know if you want to add to that, Paul.
No, I think that's right. I think we're going to see a big infrastructure program, but we had this debate about shovel ready in 2009. Assuming the Congress approves it, and they probably will, it's a year before the projects are shovel ready, and in the time frame of this of our remaining life in the fund, it's meaningless.
I think that's also the time value of money, right? Because you can hold on to some of these things for a period of time, but on the other hand, if we give you back 92 cents, right? Give us back 92 cents, and we take and invest that in something that's more sort of out there and ready, you'll make it up. It's not like you're going to take that money and it's not like a bus CD. It just gets reinvested into something more opportunistic. And that really, in summation, really is where we're at. This is a black, for Kilimanjaro, a black swan event. As Murray said, he put money in last year. Nobody could have anticipated all of this. And so, you do like we've done in the past. You take as much as you can in a reasonable amount of time. They didn't close it down in March of this year. And that money will get redeployed and hopefully grow back up over the mark. Plus, you really have to add to that all of the distributions you've had over the years. So.
Yep.
Right.
So if there are no other questions, being respectful of your time, we'd be happy to answer more if anyone has any. You can either verbalize it. Or...
I'm bummed. We're all bummed for not being able to make our traditional Houston lunch trip and see you all in person, and give us an opportunity to hear from all of you, because we always manage to learn quite a bit.
Well, we'll give you the opportunity again anytime you want to come by. We'll be happy to set it up for you, and you guys can come by. But what I can say, fellas, is that over the years, it's been we appreciate what you have done, and the integrity has been a big part for us. Last question we got here from John Beal.
I don't know if you saw it, Paul. It was what's your prognosis for General Electric?
It's going to be broken up. There'll be some rump manufacturing business. It does show you how important it is not to fall in love. There's a company that I gave 5 years of my life to. Murray gave 15. And I made a lot of money from my stock options and all that. And one egomaniac with two mouths and one ear was able to ruin it in the space of 10 years. And it went from being, I'm sorry to digress, but I was a partner in McKinsey 100 years ago. And for a long time, we used to go to clients and we used to say to them, the way they do things in Japan, and everyone would take out their notebooks because Japan was the model of great management. Well, we know what happened to that. Later on, I was no longer at McKinsey, but I was, advising clients. And I'd say the way we would do this at GE, and everyone would write it down, which just goes to show it's very important. It may have been a good idea when they did it at the time under the circumstances, but it doesn't mean it's a good idea for right now. And it's sad. For me, it's very sad. But I don't see GE ever resuming its glory.
Well, and I think GE took a huge hit because of COVID. They were beginning to make some changes, and one of the two major businesses was the jet engine business. And just watch Boeing. I mean, the number of they're going to end up with a negative order book for this year, and that business 12 months ago you would have said is a star business and one that you would want to hold on for long term. Now you're saying, well, it may be a star business, but it's going to take several years for you to get from here to there, and that's in the interim, that's tough. And so there is, as you no doubt have seen, a Wells notice out on their accounting for the insurance. So official SEC investigation for the accounting on the insurance. So it's I'm neutral. I'll say I'm not rushing out to buy any.
Doug Garrison, did you have a comment? You see, Doug? I thought I saw something pop up from Doug. No?
His comment was the way we did it at Exxon.
Oh, okay.
Yeah.
Yeah.
I mean, look at that. The great, the long-term strategic thinking. It was a model for the world, and it was.
AAA, both
and place, but it's not the time and place now. I mean, it was a great company.
Both of those companies, General Electric and ExxonMobil, were a couple of the only few AAA rated companies out there.
That's right.
AAA, right?
Yeah.
Higher rated than what the U.S. federal government is now from S&P.
Right.
And,
Crazy. Okay. If there are no other questions, I want to thank all the participants. We'll obviously continue to dialogue with these guys. They'll keep writing to us. At the end of the year, they'll put together a report for the quarter. And going forward, at any time, I know they'll be willing to answer questions. We can set that up for you. I want to thank you for your time. I want to thank you, Paul, Murray, and Amir, for your efforts on our behalf. And
with any luck and a vaccine, we'll have at least one more lunch.
There we go. Okay.
Okay.
Thank you. We'll take you up on it. Thank you.
Thanks, everyone.
Thanks, guys.
Thank you.
Thank